Hello and welcome to the Beats Roundtable. I'm Berna Barchet. Today is Friday, January, 11th. No, our group here is ready to talk the markets and their best investment ideas. With us today are Jeff Mackey, David Maris, Ben Bry. I'm going to throw it over to Jeff. We got the first pre-announcement of the upcoming ICR conference, and it's
the first good one anyway.
The first good one, yeah.
Yeah, and it was just a legit announcement. Aritzia, which is, for the moment anyway, a Canadian company, depending on whether or not America decides to rename Canada after we take it over. Anyway, they're on a weird schedule, but they reported last night, and they were just perfect. We talked about that on the show on Monday. It's affordable luxury is how they build themselves. They fill the space that Banana Republic probably should in terms of just nice clothing that women can wear to work or to someplace a little bit dressy, make nice super puffer coats and such. But they reported, and there were some takeaways that actually matter for people that are not buying obscure kind of mid-tier Canadian retailers. My own shares, but that's fine. But what they said that was interesting was that every month of the quarter got progressively better and a lot better. Now, Aritzia, they're a good company, but they don't operate in a vacuum. The thesis all along has been the good retailers showed a pretty good Christmas. There's going to be a big spread. So it is fair to view the companies that did well over Christmas they've got some upside room, because this was just a great quarter, and there's no way that Aritzia would be doing it if the American consumer anyway. They had some problems with growth in Canada, but they grew sales in the States by something over 20%. Which is just nice job, eh? So super stoked about that. I think they're hitting on all cylinders. I think Lulu, we've gone back and forth on it, you and I think they could be better than Tragic in the US. I'm not sure what the stock does, but it certainly has been acting well after really over-responding to a pretty mediocre quarter last month. The shares bounced too much. They gave it back, but they're hanging in there now, and I think that's because the results were probably pretty good. We'll hear from more companies with the conference next week. Yeah, the only other retail news was Macy's just announcing that they're going to close more stores. God knows what they are other than just a crap real estate play with terrible retail operations, and also Bloomingdale's and Blue Mercury somewhere stuffed in the box. They should probably sell the entire chain.
I think the interesting thing about Aritzia, we both knew that it was going to do well, but I think this is a conversation that you and I had offline earlier in the week, is the stock was up a lot, near highs. It wasn't like one of these things where, Abercrombie, where it had taken a hit, even though results were good. Everybody knew Aritzia was doing great, and it was up all-time highs, basically. And were the results going to be enough? I think that's the question. Everybody knows that there were some retailers that did really well, but it's reflected in the stock prices. And I think both of us were looking at names like that. The reaction could be a collective shrug. Okay, now what? And
exactly.
I'm actually pleasantly surprised a little bit that from 52-week and maybe even all-time highs, you could get another leg
when
up.
you're long something like this. Exactly. It's a really good reaction. I was listening to the call this morning, and again, because it's in Canada, you can't really tell where it's going to open, but I'm looking for reasons that people could crap on the quarter as I'm listening to the call at 2 a.m. out here. And it was just gorgeous. Again, having the US be this strong, having the boutiques reacted to just really booming and being super well received every place they open them. They didn't give you a reason. They didn't give you a foothold if you wanted to be bearish, if you wanted to take profits even. This looks like a company that really is going to have earnings up 60, 70% this year. And that says a lot of great things. The CEO was terrific. Jennifer Wong, she was a little bit of a question mark, an unknown commodity last year at this time, but her performance on the call, the way she handled expectations, the analysts in general, really impressive. And you get a good CEO and a growth company and a nice expansion story. They still are not penetrated in the States at all, but the results in the States were great. They didn't even have an app yet. So I suspect online sales will improve when they develop an app. There's just some upside here. And so it's hard to crap on them. Even expensive as it was, the PE multiple just got cut in half because they're going to double earnings. And so that helps. But it's still not super cheap, but the good ones never are.
We should have an exciting few days ahead early next week. It'll be,
I know, it's
a lot of volatility around this ICR conference. So
Exactly. If we want to trade anything other than the absolute demise of America, holy crap, the stocks are getting boot stomped. But it's maybe there'll be some good stories in retail. We're a happy place to be as opposed to the rest of these curmudgeons.
okay, I'm going to move on to David Maris, who's going to catch us up on what he's thinking about in the healthcare space.
So there are a bunch of things. So there's a news article out that talks about RFK, and he's starting to win people over, which is good news because I think actually there will be some changes. I've said it before, I do think that he gets approved. It's not a slam dunk though, but it looks like Bernie Sanders and John Fetterman are going to support him. So it's their only hope, the very left side, it's their only hope for clearing up the food issues that they perceive and cutting out some industry influence. So I think he'll make it. And so I think that's good news, not necessarily great news for the industry, but it's okay. He's not a fan of pharma and the rest, but that's not what's driving the biggest story of today. The BTK, or the XBI, the biotech index, is down over 3%. That erases all of the gains that they made early this year. It's one of the broadest base declines I've seen in a really long time. That just goes to show you, with all the excitement about the new administration, all the excitement about, there's some good clinical data that came out today from a couple different biotech companies, some deals announced the last few days. It just goes to show you that you can't beat the macro. And with rates spiking, that's what has everybody nervous and dumping this sector. Now, I think I said earlier in the week, you can erase that one though, that I had taken a basket of companies that have catalysts in the first quarter, and I decided to just buy a basket of them because I think the approvals and these are all companies that I think have a greater than 50% approval rate. And I weighted it to how the stock's been doing. Each one of them is down. So whether or not you have a catalyst coming or not, no one cares. Whether or not it's a slam dunk or it's speculative, no one cares. So I think you're going to see a number of pod shops today have serious issues. Like this is one of those days that people go home and worry about their jobs over the weekend, and their exposure is cut on Monday. So that said, Walgreens Boots Alliance, WBA, they put out a great number for them. So picture what was a disaster becoming a little bit less of a disaster. They risk adjusted EPS beat expectations by more than a dime. Looks like that the overall sales growth was okay. So this was a bankruptcy fear, and it still is, but it's much less so after today. Stock's up 23% the last I checked, and I wouldn't chase it, but that's really an investor preference. I am not somebody who I like to buy good companies that are growing, that will grow into something fantastic. This is a turnaround story. And so it has a very high dividend yield that could be cut. So they've said that. They've said, look, we're going to look at the dividend based on our capital allocation plans. So you might buy this saying, hey, it is a turnaround, but you might wake up one day and you find out that the dividend's cut and you've lost your gain. So I think it's very risky. This is a very good quarter for them, and it looks like it's sustainable. Like it looks like the decline is slowing. But again, that's just not my thing. So I wish it were my thing, especially today. It would be a bright spot of overall. But other than that, that's what's hot today, the hot news. And then JP Morgan starts next week. And the JP Morgan conference is the big healthcare conference. And a lot of companies pre-announced before that. A lot of deals are announced. And that's what you've seen this last week. I would expect that to continue next week.
So these guys, in terms of Walgreens Boots, they pay $1 a year on $11 stock, which was a $9 stock yesterday. So they're paying out like a dollar out of $1.50 of earnings. If they're not growing, and they're in harvest mode and not in grow mode, is that not sustainable?
So sales increased this quarter. So they are growing this quarter. They think going forward, that's going to be a challenge. International sales grew. US healthcare sales grew. I think that, that is the challenge, right? Debt level and not growing in the overall environment. So that's what makes it so risky. Obviously, if something was going to pay an 11% yield or a 9% yield and you were safe with it, you could go along with a lot of the volatility. I'm just not so sure that's sustainable.
Yeah, a 40% payout rate would be probably more like 60 cents here or something. And you'd be more like a 6% dividend instead of a 9. So
Essentially,
it's still a healthy dividend.
especially since they said it. But now, again, people have different risk tolerances, and they might say, if someone said to me, you know what, I'm going to put a very small position on because these kind of things you're at such a low multiple, and I think I'm going to just go for it. I'd be like, okay, I can see if that's what you want to do. It's at a price to book of 1.1. It's price to sales of something like less than 1. You can make a big case for it as a small position in a very risk oriented portfolio. But again, that's just not what I do.
Sure. No, I get it. Still confounding how a company that was good for so long became so bad. But
there are lots of companies like that, right? If you think about it, there are only a handful of pharmacies that you can go to. So it's an oligopoly, and you would think that they have amazing pricing ability. And also, if you go in for a prescription for, I don't know, something, you have a cold, you're going to buy tissues. You would think that they could raise the price of tissue, and you would think that this is like an airport kiosk, that there's you're stuck, that you're buying the $12 or $20 ham sandwich. This for some reason, all of the retailers can't make it work very well. Now CVS is up on the Walgreens print as well. Maybe it is a sector.
It's interesting you say that, because I understand front of store here much more than the pharmacy, because that's much closer to my area of expertise. And I think why it was a good business for so long is what you were saying, is that you had guaranteed captive traffic and a lack of need to be price competitive in the front of the store, because just the convenience factor of coming in. And often when you had complementary needs to why you were getting your prescription. And that kind of ability to price above market and take excessive pricing, like that started to get chipped away with the price transparency that you got from having the internet. And the more you saw the Amazons of the world move into these kind of replenishable things, be them tissues or Gatorade, the more transparent the price became much easier to look on your phone at what something should really cost. And then you combine that with inflation and people getting much more conscious around what they were paying on these relatively small dollar purchases. And it's been a share loss driver.
And as stupid as it sounds, the other thing that hurts them is just the number of pharmacies creating competition, which then it's a simple thing, drive-through. 20 years ago, when maybe we were getting prescriptions or our parents were getting prescriptions for us, maybe not 20 years ago, maybe 30 or 40 years ago, but there were no drive-through pharmacies. You drive through a pharmacy, the last thing you're thinking about is, oh, maybe I'll browse. Can you run and get me some Halls as well? Can you go and get me some Tums? You're just there to pick up the prescription and go. You're miserable and you have kids crying in the back and you just want to get out of there. That also hurts them. And that's all a factor of having so many pharmacies that they had to put in drive-throughs to compete. So it's
they killed the golden goose there.
Close the drive-throughs, I guess.
It's interesting. It is interesting how these companies, you get into the business and they're considered like the gold standard for a long time, and then they go from hero to zero, which seems like very quickly. But there's a bunch of those out there. I remember when Bed Bath & Beyond was the best retailer, and now I'm really dating myself. One bankruptcy.
I remember that.
It was
they
like
were untouchable with those 18% EBITDA margins. They were, or EBIT. They might have even been EBIT margins, Bed Bath & Beyond. That was the beginning of my career at Fidelity, and I remember covering that thing, and I was like, these guys just spin gold.
Yeah,
until they didn't, just like Eastman Kodak.
Yeah,
the 20% coupons. Holy
Kodak
crap!
was I think my first big project on the buy side, which made me want to switch from being long only to long short, because I spent so much time working on Kodak with the answer being, this thing is a short, but we don't do that. And it became a short for 10 years.
That was an all-timer short. Blockbuster, which when they were at their height, they were just raping you with the rewind fees, which sounds even silly to say right now, considering everyone would be hard-pressed to find a VHS.
Mm-hmm.
And they had that complete DMV experience in stores where you would wait in line for 25 minutes and with the videotape that you hopefully found on the shelf.
What was even better is that you'd wait, some hot title came out and you're like, do you have any copies of such and such? They go, no, but 2 are expected back today. And you'd sit there for 20 minutes hoping someone brings in ET. So stupid.
Okay, I'm reading from today's show, Nostalgia Friday, but yes.
So if anybody wants, I'll put out maybe next week this basket of 10 companies that I think they're interesting buys for a biotech play. Again, you're facing this rate debacle that's going to keep it being a headwind. But if you're looking for names, they're all down 3 to 5% today. There are some really interesting ones that have catalysts in this next quarter.
Sounds good. So now I'm going to move on to Ben, who's got some macro thoughts for us today.
Yeah, it's payrolls Friday. Job report came in hot. Bond market was not a fan. Stocks seem to not be a fan, although it's stabilizing here. Falls up a bit, and the stocks are leaking. And I guess to David's point, the stuff that's the longer duration stuff, like in his space, is really feeling some of the brunt of it. But my thoughts are this, is that we had such a move. If you go, let's rewind back to October of 2023. So the last time we had rates up in this neighborhood, the S&P was 4,200. Okay. Like we got to 6,000 and change. And so we can have a correction and then the economy can be fine. You know what I mean? I think that there's just been a divorce between stock prices and fundamental cash flows. And so I think that we can have an okay economy and a declining stock market, akin to the 70s, to be honest. Because if you look go ahead.
Didn't we have a little preview of that in late 2022? The economy didn't crash out and the market did.
Exactly. So that leads me to my second point about today. If you look at the markets, gold is up 1% today. Okay. Copper is up 10% almost in the last week or two, and oil's breaking out and oil's high. So what is the feature of 22 other than high rates and duration stocks getting crushed was commodities were ripping. And I know in our Wall Street Beats chat, Robert Marson and Bob, and they've made a case like, hey, energy's cheap. But you almost felt like a pariah talking about energy because it was so left for dead and forgotten, akin to me talking about Chinese stocks in the first half of last year. And here we go. Now we're starting to get a bid there. And I think that's something to keep an eye on, because that doesn't say, oh, things are so weak if you have oil and copper rallying. So you could have this thing where the economy is okay, but stocks don't do well. And to go back to the 1970s analog, McDonald's, which was a nifty 50 great growth company back then, had amazing stats from comp sales growth, earnings growth throughout the whole 70s. And it was a terrible stock. It was a terrible stock for the whole 70s. So you just have to be aware that could be a dynamic going forward where business isn't necessarily going to fall apart. But if your multiple's so high and now we're moving to a different rates regime, and now if maybe the cost structure is rising, if commodities come off the mat, that's something to be aware of. You know what I mean? We've had a really nice 15 months, 14 months for financial assets, mainly equities, and I guess crypto had a nice run. This could be a choppy year where you're going to have to be nimble and move around, and just getting a free 30, 40%, whatever, like we did for that 14-month run, I think that's over.
Ben, essentially what you're saying, as the kids would say, the too long didn't read version of what you just said, is that valuation matters, right? Like we might not have a complete crap out of earnings, but you might see stocks come down, is what you're saying, right? Essentially.
Yeah, I think that's right.
It's interesting because we move from like a low rate environment to a high rate environment. And theoretically, your macro class in college would have told you PE should have come down when that happened, but they didn't. So essentially what you're talking about is like a delayed reaction to what is a new rates regime in a way.
Yeah. And I think, this is more nuanced, but what really happened was we go back to the fall of 23. the Treasury made a decision and the Fed made a decision that they saw around the world just so much. It looked like things were about to break. And they decided to lower the duration of their liabilities, and they started funding the government with T-bills. So when you do that, it increases liquidity, because if we wanted to start a fund, we could get T-bills and make 4%, 5%, and then use that collateral and then leverage it and then buy anything. And then basically that increased the liquidity in the market, and then assets ripped, essentially. So now the T-bill is becoming less attractive as the Fed cuts rates and the long end's repricing. And so we all went to business school. We DCF model. When you put the 10-year in there at 5%, it gives you a different answer than it does at 4% or 3.6, or it was in September, right? So long duration assets, which equities inherently are suffering and the shorter duration assets are doing well. Like ET is a name that Robert Marson and I own. It's up today. It's hanging in there. It's energy. But I think that all the commodities up, the dollar up, short duration assets were the place to be in 2022. And so far this year, that's starting off too. So it's, does your company pay a dividend? How solid is it? What's the value? What's the multiple? Like, the higher multiple, longer away those earnings are, is the more vulnerable it is. And as we started the show off with David Maris talking about biotech just giving it up, that's as long duration as it gets in the equity market, right? That and the quantum computing stocks, which, by the way, are down like 30% in the last couple days, right? So like Bitcoin's down 10% this week from that 102 level it hit. So that's my takeaway, is that, again, I love gold, and not saying, oh, hey, you got to buy gold today, but gold's kind of sat around here. And with the dollar as strong as it is and gold trading up, especially in a day like today, you should take notice of that. Like that is a meaningful thing to pay attention to, in my opinion. And that's my takeaway from this morning.
Do you think that when you talk about the fact of higher rates for longer on the long end and it being a duration issue, that kind of hits at the Mag 7, and we've talked so much about the lack of breadth in the market and the number of stocks that underperformed the index within the S&P last year. So do you think that you made the analogy to the 70s, but what about coming out of the tech wreck, where we had, massive corrections on long duration assets? It was sort of after the Y2K period, but you had a lot of stuff that did just fine because the greater economy, the real economy, wasn't so terrible for so long coming out of the tech wreck. And you saw things like regional banks, department stores, back when the people actually went to them, things like that did well back then. So do you think that even though what you just described as a lot of headwind for the big indexes, that there could be opportunities in small cap, current cash earnings land?
Sure. Look, today, there's stocks that are up today. Energy is an area that is out of favor. That's trading okay. Energy has a negative correlation in general. Like when energy goes higher, like 22 was a great year for energy, and it was a bad year for stocks. And so energy, there's opportunities. Commodity stocks are just left for dead. Those are all starting to be interesting. And basically, I think that things that are the problem with what you're saying, though, is like, if rewind to September, me and you and Jeff chatting, I was asking about Bath and Body Works, just using that as an example, right? And you're like, oh, it's left for dead. That thing rallied a lot. There's a lot of stuff that was left for dead that just re-rated higher. So I think that it's a little bit more difficult to do that now than it was before. So now you're looking around and you're like, what's the next thing? And I guess for me, we see a scenario where the Fed clearly wants to cut because the dollar's strong, but there's ramifications to that. So are they willing to let asset prices go down? And my guess is that asset prices come down, and then we have some new policy regimes put into place. So it feels to me like we're in a transition period now. And look, it makes sense. We have a new president coming in, and we have the end of cycle dynamics. If you're bullish, you have to think it's like a mid-cycle situation, right? If it is mid-cycle, then you're just looking out and, hey, well, be in the right stocks. They're going to keep growing. Jeff Sarizia is a good example, right? Like, they're doing well. Williams Sonoma is doing well. So, you can just go that route too of, are these guys going to keep taking share? And if they're going to keep taking share, whatever. Yeah, you'll have some vol. I don't know. Like, I come back to what we've talked about a lot with Costco and Walmart, right? Dominating distributors in consumer, right? Them and Amazon, those three are like the best by a wide margin. and they all trade at insane multiples. And Amazon's a little different because of the web services and stuff. So let's just stick with Walmart and Costco, just bricks and mortar, old school. They traded multiples that are absolutely insane, but they're kicking ass. So it's like,
and you're trying to price in a whole different kind of flywheel for them. You know, I mean, it's Costco's making so goddamn much money from just selling freaking the ability to be a member of Costco. That's just like a different rethink. All three of those, you know, Walmart's, everyone's trying to price in kind of the flywheel. What's it look like if they go into advertising? That seems, boy, they sell an awful lot of products. It seems like positioning and prominently on their site would be worth a lot of money. The lead is just a yawning chasm. So to your point, Ben, it's like, when do you sell that? You can 50 points ago, and never. Somewhere between those two is a place.
It's a wide bid ask there.
Yeah, and it's not obvious what the answer is. All I'm trying to say is just know the approach that you're going with, and do understand, right? Like that, like Walmart and Costco don't need to trade at those multiples, right? Like they can keep
down 20%.
Like
down 20% is exactly the same story.
You're not going to get support from value buyers if Costco goes down 20%. That's the dynamic. I think that's tricky with these, is that you're really far from when Abercrombie went under 150. You get like people like me who missed the whole ride sniffing and saying, wow, I missed it and this is my chance. Whereas like Costco could go down 20%, another one that I missed. And it's just not enough for me to get involved on a risk reward basis. So,
and you know, it makes sense that it's like that though, right? Markets work such that Walmart traded at 50 times forever in the 90s and early 2000s, because when you have a really good story, they don't let you get the paper at a price that's cheap, or that you're like, oh, I feel comfortable. And it goes back to the old adage that making money in markets in general, the best buys are very uncomfortable. Whether it's buying a 50 times stock that keeps working, or it's buying stuff in the middle of March 2020, or Chinese stocks last year, or whatever, like often the best time to purchase and the best investments you make feel awful when you do it. And it can work on both sides of the curve.
The other takeaway from what you've said, Ben, and I agree with this completely, is that what worked last year is probably not going to work this year. And that is actually a good statement to go into most new years with. Every year is different. And we're at a point of change in the markets, and you can feel it.
And once these stories get sexy, it's too late. It's over. You don't want Walmart to be a sexy story because it's the largest retailer on earth, and it's probably just going to grow as a function of GDP. Less a little bit. You can't really get away from that. Once it's sexy, Target had its big hot moment a few years ago, and now it's one of those really super uncomfortable potential buys, to Ben's point, because it's in my blood, like quite literally. I just agonize over ways that they can possibly close that gap between the big three, because they're going to regress. Like no one gets to stay hot forever. You're already going to start to see it in Costco, with a little backlash just from America's teddy bear of the moment last year and for the last 18 months, really.
Yeah.
And I can just add one more thing to this, is that like right now, the allocation of foreigners' money to the U.S. market is at the all-time high. Okay. So the typical amount of the U.S. equity market that's owned by foreigners is around 40%. Now it's up closer to 50%. Okay. And then within the domestic savings pool, the allocation to real estate and equities is the highest it's ever been as well. So if you think about investing as just an allocation decision between duration, either you're all in on cash or as much as you can be, or you're all in on long duration, I would say the world and the US are both very positioned long duration US. And so what unwinds this is probably something along the lines of when we ever can get to a weak dollar. And so the question is, Trump probably wants a weak dollar, but right now he wants to they're clearly trying to do a deal with people. And right now he's waving the tariff stick to essentially run monetary policy, because that's strong dollar, right? If they cut deficits and they go tariffs, that just beats the rest of the world over the head. But once we get whatever is going to be accomplished, whatever their plan is, then I think we go into what you're saying, which is a weak dollar for an extended period of time. And then you get the value stocks to work, and you get like some of the stuff that's beat up, the normal stuff, the short duration stuff, and then money leaves. And then that's where the multiples on the top, because so much money just goes into the SPYs and the Qs. And then we all know that if you're in SPYs and Qs, you get Costco and Amazon and Meta and Walmart, and they all get a disproportionate amount of the money. And so it's just mechanical that they have those multiples. I don't think anyone's saying, because Jeff, Mr. Retail, he can't really justify why Walmart's at 50 times. He just knows they're kicking ass, and this is the market regime that it is. You know what I mean?
Well, more dollars going to passive versus active is one reason that this has been happening, because indexes, the way that they rebalance is if your market cap's up, you get more of the index. So they're self-enforcing momentum vehicles for the market when they're the ones taking the majority share of the money, which is what's been happening. To me, that's an argument for active investment and why we're slogging it through here, having these conversations every day. Because a lot of times it's just easier to buy the index until it isn't. And I think everything that you said lines up for, again, buying the index. What's been working may not be what works going forward. Based on
we're starting a hedge fund buying the index, only overweighting the top 5 names by like 15% and charging 2 and 20. It's a glorious model.
Yeah, that's a good business
claim
model.
That it's a black box. When people ask you what you're doing, you just tap a big computer and say, "Oh, I can't explain it."
Well, I think
you see the banks are getting they're making biotech feel a little bit better, but they're down like 2%, and that's Charlie's call earlier about, hey, listen, these banks are going to have some issues. I wonder when we get them on next to talk about the impact of the fires, because there's been some speculation that there's a lot of mortgage exposure that won't be covered by insurance, so you'll see a lot of defaults. But I wonder if that's even material for a Bank of America or Wells Fargo.
It's a lot of property, man. It is a lot of very expensive property. So I have no idea. If I had any edge in that environment, I think you're right. There's going to be money to be made, and it's way too soon to figure it out. At least I'm pretty edgeless in the space, but that's going to have an economic effect if you burn that much property in Southern California in that area.
Also,
I agree with that. I agree with that.
I think also think about the local recessionary aspects. Everybody's talking about all the homes that were lost, which is unbelievable tragedy. There are also a lot of jobs that are going to be lost in associates. A lot of gardening and home worker jobs and stuff that are just, these were big, expensive homes. Not all of them. A lot of them were working class homes too. I don't want to gloss over. A lot of people, staffs, or you don't need, if your house is gone, you don't need to staff anymore. And I think that's an underappreciated aspect of what kind of economic drag we're going to see here.
We also saw, by the way, Wall Street shed 200,000 jobs, if you saw that, for AI purposes. And so the bear market, what's weird is I started my career right before the GFC. So I still contend that was the peak of Wall Street. Even though the market's higher, you guys all been on the street forever. You remember how the street was back then. It was great. Dinners, $1,000 dinners. And it was jobs and sales and trading have been down into the right coal industry. Now AI is going to put the final nail in it. Sell side analysts, I saw a chart that
there was a huge article in Bloomberg about this week. I don't know if you saw it. I can't remember the exact numbers, but the number of sell side analyst jobs is down like 25% or something. And it's accelerating because of AI.
Yeah, and by the way,
it's getting to the point with a Claude. I use Claude. I don't know which ones you guys use, but I can have it tell me things faster than I could some analyst that I had sitting in my office. At this point, you just download.
That you paid $250,000 a year to.
Exactly. And Claude never gives me shit. They never want to eat something that smells rancid for lunch. I don't have to put up with any back talk. It's just a relationship.
I'll give you guys a hint on something that's coming. So a bunch of banks are getting together to agree that all their data. Now, some hedge funds already have this, where on a desktop they can just type in, tell me about the most recent quarter, and it will aggregate all of the research reports as well as the transcripts and everything, and summarize that and analyze it as well. You can ask it questions, but a bunch of banks are getting together to team up to allow their research so that, and not any investor, but any institutional investor, but probably they'll scale it out, can access multiple parties' research all at once, rather than, like you said, calling 6 different salespeople and saying, hey, can you send me your report on this? Or I can't log into the portal. It's locked me out. Can you help me? All of that's just going to go away.
As it should. It's wildly inefficient. It's crazy how Wall Street's still running. It's getting better, but it's still running like in that pre-GFC monitor with spreadsheets and the model needs to be changed. And maybe Charlie can get on and talk about some of that stuff because, that's part of his thesis of Long City, which just hit an all-time high, or not all-time high, like post-GFC high. The new regime high.
We got a little room there. It's got room to run before it hits resistance at those old all-time highs.
Sorry for all Citigroup people listening. That's funny. But yeah, like there's just so many inefficiencies. It's not like, hey, we're just going to cut people. And I think the AI just accelerates it because it can do a lot of the mundane work that is. Because everyone thinks about Wall Street as like sexy traders and sell-side analysts. But there's a lot of middle office people that clear trades and make it work.
Yeah, but you said you don't know why it was so inefficient for so long. It's like, why is healthcare so slow in changing major things like electronic records and sharing electronic records and all the rest? It's because the people that are employed that way don't want that change. And so I think you're right. You're running into technology advancing so fast that now, whether people don't want it to change or not, if there's a salesperson who wants to keep making those calls every morning, the 25, 30 institutional calls that they have to do and say, oh, did you see the report on such and such? That's just going to be bypassed by the ease of the technology.
Yeah. It's getting a little late, so I'm going to cut it here. We've talked a little bit about stuff that we've been talking about in the chat, and Dave talked about the report he's going to put together next week on the biotech. There's a lot more. If you go to the website, if you like what you heard, you want to know more, check us out at wallstreetbeats.com, where you can find that chat, where you can find the research. I want to wish everyone a great weekend. I'm Berna Barche, and we'll be back on Monday with more Wall Street Beats.
See you all. Have a great weekend.
Bye-bye.
Take care, kids.